Welcome back. This is part 3 of Analysing Financial Statements. If you've joined the video here, the series here, then please go back and watch part 1 and part 2. It's really important that you watch these videos in order. You'll get a lot more from the series if you do that. If you can't find the other parts, then just go over to my website, freebookkeepingaccounting.com. That's www.freebookkeepingaccounting.com. And you'll be able to see my free videos on that website. Okay, so in the previous videos, I've been through a number of things. In the previous video, though, I went through these formulas and ratios and how they can help you analyze the financial statements and what these ratios and percentages actually mean. I explained these formulas, and that's all covered in the previous video. Now comes the exciting bit, because we're going to look at a set of financial statements, a profit and loss statement and a balance sheet. For example, company limited. The figures in these accounts could be real figures from an actual company. They are all dummy figures. This isn't really a company. Example, company limited. This isn't really an accounting company. False accounting company limited. It's all dummy, it's all fake for the purpose of this video, but the figures that I'm using are accurate as if they were an actual company. Hopefully that makes sense. So what we're going to do is I'm going to go through the financial statements in this video. You have 4 pages of statements and information about the company, written statements, and then we hit the profit and loss account and balance sheet as covered in previous videos. So we're going to go through and analyze these accounts. I'll go through slowly. I'll try and remember everything that I wanted to say. Just so you know, none of these videos are ever really scripted. None of my videos ever are scripted with the Bookkeeping Master. So sometimes I'm a bit all over the place. And that's purely why I'm just talking from the top of my head, really. Okay. So I'll bring up my notes and we'll start a new sheet here. We'll look at the profit and loss account and then the balance sheet. If I do my job well, then hopefully you'll be amazed about the amount of information we can find out, financial information. We can find out about, example, company limited by simply looking at the profit and loss and the balance sheet. Because what generally happens is a company director, company owners, or even accountants, or entrepreneurs or investors, whoever they are, they'll look at the profit and loss. They might look at the sales figure. They'll look at the profit figure. They're only really interested in how much money the company made. And then they'll just skip over the balance sheet completely. Or they might want to look at the profit and loss account or something, or the amount of cash that's in the bank on the balance sheet, and that's about it. They're only scraping the surface of what these financial statements can actually tell you. Someone that can analyze financial statements well can really find and identify ways to improve the company and plan for its growth. Too many people don't understand bookkeeping and accounting, financial statements, and they're missing out. Because accounting is the language of business. That's what it is. Okay. Profit and loss statement. Here, my notes. What I'll do, anything positive, let's mark green. Anything, that doesn't really have a significant impact either way, we'll just use black. Then anything negative we'll mark as red on the notes. So let's just start right at the top with turnover. So turnover, sales for 30th of April 2019 was around about 3.3 million. Now that doesn't really mean anything by itself unless we compare it to other accounting information. So we can compare that to the previous year. If we've got further years of accounts, we can compare that to even more than this 1 year. But let's just look at the figure. So 3.3 compared to 420,000 the previous year. So 3.3 million in sales compared to 420,000 the year prior. Is that a positive thing? Of course it is. Sales are increasing. So we can just make a note here, sales increase from prior year. Now these notes might not make too much sense. I'm simply just making some very quick and simple notes, otherwise this video is going to go on forever. So this is a green, it's positive, sales increase from prior year. Now if you don't really think this is much of a positive thing, then you really don't understand company profits, because company profits are increased or decreased in two ways. Either sales go up and profits go up, or expenses go down, including cost of sales, go down and then profits go up. There's two ways that a company becomes more profitable. It either sells more or it decreases its expenses, overheads, purchases, anything that's taking money out of the company. So if sales are increasing, that's a really positive sign. If you still are not convinced, think of the negative. If sales are coming down each year, if you have 5 years of accounts and each year the sales figure is dropping, that would be a real warning sign. If I was an investor, that is something that I do not want to see. I want to see sales increasing. Now, if sales are pretty much the same every year, that's also a positive. You have a very steady sort of company. It's always turning over about the same every year. That's still a positive sort of indicator on the accounts. It's not as good as obviously sales increasing each year, but a steady income each year is also a good thing. The only thing you don't want to see is no sales or sales decreasing. So that's great. So let's look at cost of sales. Now, cost of sales has also increased drastically. So if we look at the sales here, we had 3.3 compared to 420,000 the year prior. If we look at cost of sales, we have $2.5 million or pounds, euros in cost of sales compared to 272,168 the year prior. Now, is that a negative thing? Not so much as, or it doesn't have so much of an impact as these sales figures. The reason being, if sales goes up, then cost of sales is likely to go up. So seeing that we've had such a huge jump in cost of sales isn't that concerning, because sales have gone up. Cost of sales are directly linked to sales. So the more sales we're making, the more cost of sales is going to be. So that's kind of expected. Now, this would be a warning bell or a warning sign if cost of sales had gone up drastically, but sales hadn't. That would be worrying, because that would really impact gross profit. So I'm not too worried about this figure. We could look at percentages. We could say, well, cost of sales is a higher percentage than it was last year. But we don't need to do that, because that really comes into play here when we look at gross profit. So if we look at gross profit, and let's work out the gross profit margins for both years and see how the business is performing. Overall, gross profit is up. We made 150,000 roundabout gross profit in 2018 and about 750,000 in 2019. So that is really good, and expected if sales have gone up. Once again, if sales have gone up but gross profit was the same, that wouldn't be a good sign. So let's put gross profit increase from prior year. Okay, so that's a real positive sign. But let's look at actual margins here, gross profit margin, because that will give us a better indicator of what's actually going on. Because it's easy to say, well, it's increased, that's a positive sign, but has the gross margin percentage actually decreased? That would be something worth noting. So gross margin, as mentioned in the previous video, is gross profit divided by turnover times by 100. So let's look at 2019. Let's bring this up. So we have 746,437 divided by 3294443 times by 100. So the gross profit percentage, or the gross margin for 2019, is 22.66%. Okay, let's look at the same. If we clear this, then it'll show to the right here still. So for 2018, we had 148,442 gross profit divided by the sales times by 100. So for 2018 we actually had 35.29%. So that's quite a big difference, isn't it? So we got 35.29 minus 22.657. There's actually about 12.6% difference. So even though gross profit is up, gross margin, so gross margin is down. So thinking about the previous video, the cents we're making per pound sale or pound dollar sale or pound or euro sale, this, the pennies, the cents we're making in gross profit is actually down. Overall, it is higher because we're making a lot more sales, but the actual margin we're making is tighter. So that's marked as red. So we have administrative expenses, 642,117. Once again, this is expected if sales have increased, because the more sales you're making, the more your overheads could be going up. Things like wages and things like that. And we'll come to that a bit later on. So we then have interest payable here. So our interest payable, our finance costs have risen drastically, 40,000 to 5,000. That's not as expected when sales go up. If anything, you would hope finance costs go down a bit or stabilize. But we'll come back to this a bit later on in this video. So net profit, let's look at net profit now. So net profit is up. We made 25 grand roundabout in 2018 net profit and 65 roundabout in 2019. So that's a good sign. So net profit has increased. So let's mark that green. But let's have a look at net margin. So going back to the calculation in the previous video, net margin here. So let's do 64,317 divide by the turnover times by 100. The net margin is 1.95%. Now let's have a look at net margin for the previous year. We have 25,643, 420,610 times by 100. We have 6%, 6.1% roundabout. So once again, similar to gross profit, the net profit has increased from prior year, but net margin is down. We're not making as much money per sale as we were in 2018. But overall, we are making a lot more money because we're making a lot more sales than we were in 2018. So net margin is down. So there's a few very basic things to note. Now, if we want to take this to the next level, what else can we look at? Well, what is a healthy gross margin? Our gross margin is around 22.7% for 2019, 22.66%. Is that healthy? Well, as a rule of thumb, I suggest 25 to 50% gross margin is healthy. Now, once again, this changes per industry. For some industries, 20% is a healthy gross margin, whereas other industries, 90% gross margin is the healthy margin. So it does change per industry. But as a rule of thumb, 25 to 50% gross profit margin, gross margin percentage, is what you should really be aiming for. And this is at least 25 to 50%. We're getting 22.66%. So it's not really that healthy. We are making a profit, but not as much as we should be. There is a bit of a warning light here. And how about net profit or net margin? What is the percentage? We said it was 1.95%. So every pound or every euro, every dollar, we're making about 2 cents, 2 pence profit. So it's very tight, 1.95%. It's a very tight margin. Once again, what are we looking at? I would say 5 to 20% is considered healthy. If you're below that, there are some warning bells there. The net margin is only 1.95%. That is very low, isn't it? 1.95%. It wouldn't take much for this company to actually start making a loss. 64,000 euros or dollars or pounds might seem like a healthy profit, but not when you're turning over 3.3 million within the same year. So that's something else we might know, is that margins, there are profit margins there, but they're very tight. Now we can take this even further, okay? And we can have a look at this admin expenses and try and see if there's anything actually in this admin expenses that is taking its toll on profitability. Now, the two things to really look out for are things like research and development costs, because it could be the company's putting lots of money into research, which it won't be doing in future years. So in 2020, if £200,000 or dollars of this is for research, which it won't be doing in 2020 or 2021, then you got potentially $200,000 or pounds more profit in the bank, which we currently don't have. Now, something else to look out for is directors' wages or shareholders' wages. Anyone that owns the business that's paying themselves, not their share of profit, but a wage, a salary that they're paying themselves. So if I go down to the bottom here, we have detailed administrative expenses, where we can see a breakdown of what that admin expenses is. Now, I haven't gone through and listed all the admin expenses because it's not needed for the video, which take far too long. But if we look here at directors' remuneration, that's £288,000 has been paid out to directors. Now, if we go back to the notes up here, how many directors are there in the company? How many owners are there? There's just one, which is false director. So the director is actually paying himself $288,000 in the financial year. If we take that into consideration, that about a third of admin expenses is actually the director's salary, then profits actually look a lot better because he doesn't have to be paying himself or herself that much money. So if the company director was to actually cut their salary in half, instead of taking 288 a year, they took 144, then we're going to see profits go from 64317 plus 144,000 to just over £200,000 per year. Now, if we work out the new net margin based on that figure, so divide by 3294, divide by the sales, the turnover, times by 100, you've got over 6% margin. Now, I'm probably going through this far too quickly, and I do apologise if that's the case. Just rewatch the video. But what I'm trying to say is these figures aren't always what they seem. If you have one-off costs that aren't going to be applicable in future years, obviously profits could be expected to rise in future years. And also things like directors' wages. If there's 1-2 directors and they're paying themselves a large sum of money, take that into consideration, especially if this is a business that you're planning to purchase, because you don't have to pay yourself this much money. If you were to just pay yourself $50,000 a year, then you're going to see company profits rise drastically. So it's always worth looking into those things. So taking that all into consideration, I would actually say overall, so taking directors' remuneration into consideration, net profit is healthier than first thought. Okay. That doesn't mean this changes gross margin, because this is admin expenses which comes off gross profit. But from a net margin, that 1.95% that doesn't look healthy could actually be more like 6, 7, 8% if that director's remuneration was reduced. Okay. I need to take a breather. I'm talking a lot. Okay, so let's move down to the balance sheet here. So we have some fixed assets. We have debtors, 431,154. We've got cash in the bank. We've got creditors. It's quite a simple sort of balance sheet. The share capital and a profit and loss. So a very nice, easy sort of balance sheet to work with. So we have a debtors balance here of 431,154. Now the first thing I like to do when I see a debtors balance is try and work out how much of this debtors balance is compared to turnover. So if we were to do the whole turnover for the year, 3294443, if we divide that by 12, on average, you know, the business might have some seasonality to it. You know, the sales might be seasonal, but on average, we have 274,536 sales per month. If we look at the debtors balance, though, it's 431,154. So we've got well over 1 month's worth of sales in debtors, which isn't a good sign. If we're aiming for 30 days payment terms, we've got well over 30 days payment terms outstanding with our debtors. Now what we can do is look at the notes to the accounts to see if this is all trade debtors, because it might not all be trade debtors. So we go down here. Okay, there's a slight amount that's other debtors, but trade debtors, it pretty is much. That whole amount is 428. We got 431, so about £3,000 difference. So 431,154. There's a lot of debt outstanding, and we can even do debtor. If we bring up the thing, we can even do our day sales outstanding, our DSO. So that's the debtors balance divided by credit sales times by 365. So let's have a look at that. So DSO, I'm saying it's well over 1 month. That's outstanding for, well, let's actually use the right figure, which is down here, 428,335, divide by the total sales, 3294443, times by 365. It's 47 days, 47 and a half days outstanding, 47.5 days outstanding. Now you really want 30 days roundabout outstanding. Anything more than that is considered negative, and obviously the higher this figure is, the more negative that's going to be. I can understand 35 days, perhaps even 40 days, but we're nearing 50 days here outstanding. That's not a good sign. Let's go back down to the balance sheet. We have cash at bank. Now, cash at bank is a real interesting figure to look at, because we can compare that to the cost of sales and the admin expenses of the company. And we can actually see if the company has the cash in order to meet its financial obligations. So if we look at 62534, that's the cash in bank. If we were to look at the cost of sales, which is 2548006, and if we were to include admin expenses at 642,463, this is our roughly total money out for the year. There'll be things like depreciation included in this, so it's a very rough figure. It's not exact, but these are our outgoings for the year. If we divide that by 12, we get an average monthly outgoing figure. So that's 265,872. So roughly every month there's 265,872 going out of the bank. Now our bank balance is only 62,534. If your bank balance is 62,534, nearly 63,000, and you have outgoings of over $250,000 every month, that's a real warning sign. There's not enough money in the bank to meet the next month of financial obligations. That is really worrying. Now, obviously, there'll be money coming into the bank through sales and debtors paying into the bank. This company isn't about to go under. I don't think that's the case at all. But this is a real warning sign that cash in bank is extremely low compared to monthly outgoings. And if you've got any questions about any of this, then please just ask me, because this is quite in-depth stuff. So cash in bank is extremely low compared to monthly outgoings. Now, just to back all this up, let's do our current ratio, which is going to be the same as an asset test, because there's only two current assets on the accounts, and they're both considered liquid assets. So let's do our current assets divided by our current liabilities. So that is going to be 431,154 plus 62,534. That's our current assets divided by our current liabilities. Gives us 1.18, I would say, if we round up. So 1.18 asset test or current ratio. So it is in the green because 1, as mentioned in the previous video, a 1 score, a 1 ratio is like a critical, and anything below that is even worse. So we are in the, it is a green, but it's not great. I'm going to leave that as black because it's not great. Now, why don't we compare that to the previous year and see if it's actually improved at all? So in 2018, we got 104,979 plus 50,624. Divide by 134,751. So the previous year, we were 115. So the asset test has actually improved since prior year, which is a good sign. So let's give that a green. There has been some improvement since the prior year. The company seems to have a bit more liquidity than it did in previous years, but it's not doing that well, really, overall in meeting its financial obligations. Now, what other ratios we got? We got accounts. Okay, so that's all our ratios done for these accounts. I'm not going to do accounts payable turnover because, as mentioned in the previous video, I can't work out what is credit purchases and what's not credit purchases. We got a healthy amount in the profit and loss account, so profits are being retained. We have retained earnings there, which is a really good sign. So looking at the notes we've created, we've got a number of reds, a number of greens. We can create a summary down here. But before we do that, let's just look at a few more figures on these accounts that don't necessarily require ratios or formulas. It's just being a bit of an investigator and trying to work out what's going on. So my main concern about these accounts is the cash in bank is so low and the debtors is so high. Now that screams really one thing at me, and that is cash flow difficulties. So if you don't have much money in the bank and your outgoings are very high, it looks like to me this company is facing cash flow difficulties. Better than it was probably the prior year, but still facing cash flow difficulties. Now, something else I noticed when I was looking through these figures is that this interest payable figure has increased drastically. 40,000 compared to 5,000, which is fine. That can happen. But what we don't see on the accounts is a loan. We've got a creditors amount. If we go down, you can see that most of that is trade creditors or money owed to through wages, things like that. There's no bank loan there. So if a company doesn't have a bank loan, and it would need quite a significant bank loan in order to be paying $40,000 in interest, doesn't have a mortgage or anything like that. So what's going on? With a bit of experience, this is a sign that the company has started some sort of factoring or invoice finance. And if we were to look at bank charges too, if that was showing, if we can compare that to previous year, we'll probably see that that's increased too. Because it could be that the bank is providing the factoring or invoice finance. So what is happening here is, because of cash flow difficulties, this company's probably got some sort of invoice finance or factoring system in place where the bank is giving them money in advance for their invoices, and then they're paying the bank later once those invoices are paid. And I don't want to go into invoice factoring and invoice finance and factoring, because it would take forever. But that just reinforces that this company is struggling for cash. Companies always go down the invoice, not always, but companies that go down the invoice finance and factoring route do so because they're struggling for money 99% of the time. So, if we were to write a summary about this business, I would say it's a profitable business, especially taking into consideration the director's remuneration, which could be reduced. So we have a profitable business that is showing good signs of growth, especially when you look at the sales figure and the profit figures. Things are really moving in the right direction. But what we do have is a company that has experienced cash flow difficulties, and I would say needs an immediate injection of cash, or sort of like a revamp of cash flow tasks. So if the company's not doing a cash flow forecast, it needs to start doing it. If it doesn't have someone chasing the debtors for payments, it needs to start doing it. It needs to find ways to save cash, because cash is king in a business. Even if you have a very profitable business, if you run out of cash, you're out of the game. So I would say this is a very good business. If I was looking to buy this business, I'd be very interested. It's really growing, it's moving in the right direction, but I need to be aware that my first task is to sort out the cash flow. If I'm the owner of this business already, cash flow is what's screaming out from these accounts. We've got hardly no money in the bank. We have debtors that aren't really paying their bills. Our assets just meet our liabilities. There's cash flow difficulties here. Now, if we can reduce cash flow, or not reduce cash flow, if we can improve cash flow, then we can also get rid of invoice factoring and potentially save ourselves about $40,000, pounds, euros a year in these finance costs here. So we can become even more profitable if we can improve cash flow. And we can improve cash flow in a number of ways, and I can cover that in another series. Okay, now just scrolling down, we've got some notes to the accounts here, which I've used a couple of times. Shows the trade debtors, trade creditors, and other things. Admin expenses, I showed this a bit earlier too. Now, I've listed a couple more figures here because these are two figures I wanted to highlight out. Too many people, when they look at accounts, as mentioned earlier, there's two ways to improve profitability and potentially improve cash flow as well. That's to reduce expenses or increase sales. It's what people try and do when they reduce expenses. There's two areas they generally are tempted to reduce. That's advertising or marketing. But what they don't realize is there can be a direct relationship with marketing and sales. So they might reduce their marketing budget or advertising costs in order to save some money, but it totally backfires because their sales dip along with the advertising costs. So that's always something to be aware of. And also wages is another. Generally, staff costs are the biggest cost for any business. When they're trying to save money, they start making people redundant or downsizing, whatever you want to call it. But once again, this can backfire, because if you then have staff that have too much to do, because there used to be 5 people in their department, now there's only 3 or 4. If they've got too much to do, their production's probably going to go down. You're going to have a higher turnover of staff. You're going to have lower morale amongst staff. And all this leads to less being done and less production, which then has a huge impact on profitability. So I thought I'd mention that too. Okay, hopefully this series has been good. Hopefully it hasn't been too in-depth for you. I wanted to try and keep it simple and understandable. But yeah, thank you so much for watching. If you've watched all 3 parts and it's been helpful, please like. If you would like me to analyse your accounts for you, drop me an email. I offer that service for a small fee. If you would like me to train you on how to analyse accounts, then once again, I can do that for you. Just email me. My email address is info@bpfs Bravo Papa Foxtrot Sierra -online.com. Thank you for watching. This is the Bookkeeping Master. Please feel free to watch more of my videos.